The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good Tuesday morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN. Tuesday morning, 9 a.m. Eastern Time. We got about 30 minutes to go until the start of trading, and the S&Ps are trading at quite a round number. We're trading at 4,000 on the dot, folks. You're negative by 6 points. A little bit of volatility overnight. We put it on a 5-minute chart. You see the action at about 3 a.m. Eastern Time. We make it to a high of about 4,025. That's pretty close to the Europe Open, right? Somewhere like that. And then, basically, for the last 6 hours or so, you've been trading lower. We just made lows in the last hour at about 39.97. And as I said, trading right at 4,000. NASDAQ 100, we're negative by 12 points. Pretty much unchanged. Pretty similar action to what we were doing in terms of in the S&Ps. You trade higher briefly. The slide begins at about 3 a.m. Eastern Time. Dow off 25 points right now, and the Russell off by 5. Bitcoin. We were at 28,000 yesterday. A little bit of a drop-off, man. You go to 26.5. Today, we're trading at 27,000. How about crude yesterday? Accelerating. Friday, 66 handle. Yesterday, 73 handle. You talk about volatility. Right now, just under that price point, 72.93 in the price of a barrel of crude. Gold pulling back hard yesterday, down to below 1950 this morning. We're up $9 on the session. Now, remember, gold session is from basically yesterday afternoon. It doesn't get you all the way until 4 o'clock like the equities. Nonetheless, you still see volatility, man. We were at 1950 at 5 a.m. We were almost at 1970 in the last half hour, and we're trading at 1962 right now. The action continues in notes and bonds, a little bit of a pullback to put it lightly. Friday, we're at 117. We zoom in on yesterday's action. We were at 115 or so. We just made it to 114.20, man. Where are rates going? Where's the 2-year? Where's the 10-year? Where's the 30-year? It's just wild, the movements we're getting. That's the 10-year. You jump over to the 2-year, and just mammoth moves on the 2-year, almost historic. 102.29 on Wednesday to 104.11. We're at 103.11 right now on the 2-year. We jump over to the dollar index this morning. Dollar index, we back off to 102.40. We were above 103 yesterday. We were at 101 last week. Absolutely remarkable what's going on the dollar index. We put this on a little bit of a daily. You can see dollar kind of coming back in to where we were the lows of February 2nd. I mean, the relationships playing out in this market, folks, are changing ever so quickly in terms of yields, expectations going forward, the cost of capital, etc. And we'll kick things off. Well, before we do, let's check out the VIX. Pretty interesting that we get a paired VIX. There was your banking crisis. We spike up to 30. You're back to 21, just like that. We put the VIX. Zooming in just on the last year, okay? It's a pretty decent high. And, you can see sometimes there's lulls between the highs, as in you go back to last May. By the middle of June, you were back up there. But then you go from June to October. You traded all the way down to 19 and change. Nonetheless, that's the first spike of the year, up to 30. The one thing that's interesting on a fundamental level, right? And okay, I'm going to zoom this in on the last year on a daily. We zoom things into basically where we were before the banking crisis, which was just about here and then here. I think this sell-off on March 7th, if I'm correct, was Chairman Powell speaking 3 weeks ago today. 3 weeks ago today. Imagine that. Time flies, right? Chairman Powell speaking, saying we're going higher for longer, man. Higher than expected. Higher than expected. Something to that degree. The banking crisis unfolds that Thursday. We go into Friday. We open Monday, March 13th. Things are still wild. And then just like that, we've had higher highs and higher lows. We've clawed it back. And basically, it's just like the banking crisis never occurred. What I can't comprehend is how that means the market is where it should be. Because if anything, all it means is that we've got the higher rates quicker, right? These are kind of conversations I'm having with myself on a fundamental level. If the banking crisis has tightened up the economy, which it very well may, that means that it's akin, you heard the conversations, right? We were talking about the Fed. We wanted Chairman Powell to tell us, say, hey, what are you guys modeling in terms of do you think the financial crisis going on right now is going to be akin to like a 50 basis point hike or a 75 basis point hike or 25? They don't know, okay? They have no idea, just like we have no idea, folks. But what I find so interesting is even if that's the case, okay, now, yeah, The Fed might have to curtail how high they go because the pain on the balance sheets for these banks is just going to get worse. And if they just keep going higher, the unrealized losses for hold-to-maturity securities are going to keep getting higher. We've talked about them, man. I keep seeing articles every single day. I was reading a couple about Schwab this morning. I was talking about Schwab on my show yesterday. I was reading the articles this morning. I said, was this the article I was reading yesterday when I started talking about it on the program? No, it's a completely different article. 2 of them written by Bloomberg within the time that I talked about it yesterday. So can the Fed go higher? It's going to be tough because the strain on those banks is going to be difficult, especially the ones who have mismanaged themselves spectacularly, like Silicon Valley Bank and Signature. Signature's in the press this morning. You have those banks actually back open and trading for the first time, people with options actually able to execute those trades and get out of those trades for almost 100% gains. Pretty remarkable. But back to the point, they're going to have to stay there, even if they can't go as high. The fact that the market's pricing in so many cuts, that's always been the most astounding thing. Okay, because you can make a very reasonable case that, hey, man, everything's going on. What's the harm in pausing? Okay, what's the harm in pausing maybe after one more hike? Maybe what's the harm in pausing if we get some good data ahead of the May 2nd and 3rd meeting? It's not akin to cutting, okay? And I think the bar is going to be much bigger than many are thinking when you talk about the bar for cutting. And guess what? There's much greater scenarios that could play out in terms of them just hiking, and we get one of them this morning in terms of BlackRock. Yeah, markets are wrong on U.S. rate cut bets, okay? The Fed has made clear that the banking woes won't stop rate increases. U.S. central bank may cut rates only if credit crunch worsens. They're reasonable takes, folks, and I would just use your brain here. I mean, think about what we were talking about in terms of the phrases of transitive, right? And the one thing, even myself, everybody, okay, it's human nature. You have the habit of saying, oh, man, do I not know more as much as the Wall Street Titans, right? Do I not know more than the market? You never know more than the market to the degree that the market's always right, man. Where price equals supply, that's where the market is. You can't argue that the market's wrong right now, that the S&P is trading at 39.98 because it's trading at 39.98. So therefore, that's where it's trading. I know, kind of a conundrum, but nonetheless, realize that you're allowed to disagree with what the market's saying. And yeah, if you're wrong, you might lose some money, man. That's how it goes. You got to have business. You have to have biases. You have to have opinions. If you just follow the market rhetoric, you can't beat anything because that's what's already priced in. You have to have an opinion, folks. And, what our man Kevin Hincks says, we're going to talk to him coming up after the break. Perfect. He's already on the line. He's waiting. We're going to go to a commercial break. You know what? No, let's jump to him right now. Let's jump to our man Kevin Hincks, and we're going to go into the break, but he's already on the line. Kevin Hincks, good morning.
Tommy O'Brien, how's everything?
Everything's going great, man. I was about to talk to you as a little bit of a segue, talking about this market.
Yeah.
And I lost my train of thought a little bit, Kevin, because I saw you up there. I said it, but what was I saying? I was saying that, I'm going to blow it. I'm going to pull it up at the break, Kevin. We got the S&P at 4,000. I know you're on the phone a little bit early. We got a 3-minute break, folks. We're coming back. We're going to talk to our man, Kevin Hincks, and we'll talk a little bit about rates as we go forward into the end of March with the market at 4,000. Stay tuned, folks. We'll be back with our man, Kevin Hincks, coming up right after the break. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years years' experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. We get the markets. S&P negative by 7, right at 4,000. And let's jump over to our man, Kevin Hincks, folks, every trading day, 12 noon Eastern time from the TD Ameritrade Network right here on Tiger TV. Fast Market with Kevin Hincks, Tom White, the whole team, an outstanding program. And let's just jump right into it. Kevin Hincks, what do you think about the market sitting basically right where we were prior to all of this banking crisis coming into the action right at 4,000? We'll kick it off with that.
Yeah, it's been an interesting trade in banking. You know, you had massive amounts of worry and uncertainty when SVB hit. But, you know, Michael Barr, the vice chairman for supervision, is putting out his report today at about 9 o'clock Chicago time, 10 o'clock Eastern. And he already basically released some of the text from it. And it basically puts this problem at SVB square on the shoulders of their administrators. And they didn't understand. Here's the quotes. Failure to develop effective interest rate risk management tools, models, and metrics. Failure to manage risk of its liabilities. Deposits from the VC firms in the tech sector, which were highly concentrated and could be volatile, made up a lot of their deposits. So what they're basically saying, and you're starting to see it in, you know, the S&P banking index up 3% yesterday. There was uncertainty, and now there's less uncertainty. As this looks like, this is, Tommy, what we've learned, some firms are better at judging and hedging and assessing their risk, and some aren't. And unfortunately for the stockholders in SVB, not the depositors, but the stockholders, they're going to pay the price for mismanagement by this firm. So the risk there doesn't look like it's spreading to other firms. Doesn't mean that firms won't have, you know, issues with their bond portfolio, but it's not going to be anything where there's bank failures. And it looks like even, Tommy, there's some demand now for some of the assets in some of these banks. So the banking crisis that was a week or so ago, Tommy, it looks like it's dissipating. You see that in the activity of the banking stocks.
It's pretty wild, man, that basically they're making wagers, man. They're making trades to the tune of, what, $100 billion here and there. They're taking that money. They're putting it in investment. They're supposed to earn more in that investment than they're paying out for the depositors. And, boy, we all got a quick lesson, man. Hold to maturity securities and the losses that are in there. Boy, things escalated quickly. And, yeah, they made a decision. And pretty remarkable that the risk of that decision basically bankrupted that company within the span of 12 months. So quite a decision. We're a little light on economic data this week, Kevin. We come into April, of course, next week. We're, 5 weeks out from a Fed meeting, so we get all the March data as we go into April. Market's sitting, as I said, pretty decent round number at 4,000. A lot of the conversation I was reading this morning, an article at the top of Bloomberg talking about BlackRock, saying that the market's wrong on the rate cuts. Now, we can talk about hikes. They haven't even paused yet. I know. I love the phrase you say that stay short, stay current, don't go out too far, because that's where you really can get yourself into trouble. And I love that phrase, man. With that in mind, how far are you comfortable going out right now? As, I've been talking about, Kevin, to give you, so we get the May meeting, May 2nd and 3rd. So we're going to get all of the March data through there. But then the next meeting in June, we're going to get 2 months of data before we get to the June meeting. Where do you see? Because it's hard for me to comprehend right now that we get any level of cuts like the market's pricing at 100 basis point cuts by the end of the year. What do you think of those types of conversations? How does your head wrap it around that type of market rhetoric right now that's everywhere?
Yeah, Tommy, I never say always, and I never say never, but I believe that there's a very small probability that the Fed raises rates to here and then cuts in the second half of the year. Now, do I think now, if there is some type of an event that would be catastrophic to the U.S. economy, and you can put the list out there of what you think those might be, that could change the Fed's decision. But there would be, I think, Tommy, without an event that would change the direction of the U.S. economy, I don't think there are Fed rate cuts coming on this year. And those markets that are building in or trading like there are may have to do some adjusting along the way, and that may dissipate over time, just like other things, flare up and dissipate over time, Tommy. So I think that long-term look, when I'm saying 9 months out, 6 to 9 months out, that's still something that has to play out. So for traders, I think stay right in the present here and trade this market that we have coming out that's about to get first quarter earnings in a couple weeks, Tommy. So we're at the end of the quarter here. Things are going to get interesting. I mean, you've had the tech sector, high cap tech, excuse me, that have had incredible runs in some of their stocks. Look at the chart on Meta,
Yes.
It'll be interesting to see how they trade into their earnings. And has there been a dramatic increase in digital ad spend? If not, remember, all these companies are working on the expense part of their ledger. Let's see what happens with digital ad spend and if the numbers and the revenue numbers get better. So there's a lot going on. But we will get income and outlays on Friday. We will get third look at fourth quarter GDP on Thursday. So there is some data. But right now, the next one we have, Tommy, we've got consumer confidence coming out here at the top of the hour, and that they're looking for about a 101, a slight decrease from month over month in consumer confidence. So, yeah, we're at the end of the season. Still some good names today, Tommy. Though today's show, we're going to look at Micron that has earnings after the bell today, and Lululemon that has earnings after the bell, Tommy. And then we'll trade Disney in our third segment. So real good show today with some earnings. And even though we're thin on earnings, we got two good ones today.
That's awesome, man. And Disney is a personal favorite, Kevin. I was turning on Disney this morning with little Tommy, man. We're eating some breakfast, watching a little Disney, watching a little Cars, watching a little Lightning McQueen, man. So I'm biased. I got some Disney in there from my retirement portfolio. Real quick, Kevin, we have about a minute and a half, but back, and I appreciate the insights that you give us, man. When I ask you these questions, I'm always listening with 2 ears, man, and you make me feel a little bit more sane on a morning like this morning where you answer talking about the cuts. What do you think, Kevin, that, and the market has, you say it's repriced, as in the market has been in disagreement with the Fed, and then you've had the repricing that's occurred to kind of go back in alignment, and that might be what's going to happen. Do you see pressure on the market sitting at 4,000 right now? Because I'm trying to wrap, so either maybe the market kind of catches up to what I think and maybe what you think, as in the, cuts aren't coming. So that might put a little bit of pressure on the market. Or you have the scenario that an event takes place and they have to cut, and that might put pressure. Is there going to be headwinds for both of those scenarios? Because I'm trying to find a bullish scenario in my brain. It's a little bit hard, especially, really to the upside when the two scenarios are, wait a second, maybe there's no cuts, or maybe, like you said, there's, worse things out there that could happen that could result in the need for cuts. How do you think about that with the upside downside risk?
Well, when you look at what we're about to get, which is first quarter earnings in a couple weeks, I think the market will move off of two things. It'll move off inflation. The progress that the Fed is making on inflation and the moves that they make, either a little more harsh or a little less harsh. We'll see based on the data what we get there. And then it's earnings, right? I mean, some of these stocks have been beat up so much that I think their first quarter earnings are going to be critical in Google, Alphabet. How about Amazon and how low that stock has gone down? Why has that stock gotten hit? Well, e-commerce isn't making money, and their is starting to slow down. So let's watch what Amazon does as they start laying off people now.
Kevin, I appreciate the time as always, man. On a busy morning, we'll be watching today, man. I'll be watching Lululemon, Amazon, Lululemon, Disney, and Micron, folks. And we'll talk to you tomorrow, Kevin. Have a great Tuesday, man.
Thanks for having me on, Tommy.
We'll be right back for the open, folks.
Be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern, for free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open, slightly in the red. S&P's right now negative by 6, trading at 4,001. It's an interesting conversation just having with yourself, right? When I was talking to our man Kevin Hincks, How do you go to a cut? Things are going to have to be pretty dire. If the Fed goes to a cut, they're going to have to be extremely dire if they go to a cut by 100 basis points. So there's two scenarios that play out. Either the market gets in line with what the Fed is saying in terms of they come to the realization that, guess what, we had a banking crisis, but we are going to not see cuts at all. Now, how high we go, okay, and I tend to agree with my dad. He's been talking about it's going to curtail things. I don't know about the cuts, though, man, because, yes, the banking sector is probably in more trouble than we realize. It might be a little bit more teetering than we all realize, okay, and it's not going to be 2008. It's not the same deal, not even close, okay, but it's probably a little bit closer than we all realize because you don't know what you don't know, right? But I don't see that taming inflation. So if that doesn't tame inflation, cuts are going to be very difficult. If cuts are very difficult, then that means the market is wrong with where interest rates are going to be. The only alternative is that something really bad happens that causes the cuts. Well, that might be bad for the market too. Where is the headwind for the market? The headwind for the market, okay, this is the bullish case. The bullish case for the market is the market's right. The Fed's going to be forced to cut. Somehow inflation will go away. The Fed will cut, interest rates go back down, inflation is not as persistent, and the markets go up. I don't see that one playing out, folks. And so we're going to get to find out. And as Kevin said, we're coming into earnings, man. And it's going to be an interesting earnings season, to say the least, coming into first quarter earnings. And yeah, this is the last week in March. We kick it off in April. And as he said, we get some interesting companies coming up today. We jump over to Disney, man. Disney, talk about taking it on the chin recently, right? You trade up on some decent earnings up to 118 back in February, and then boom, just like that. You trade down to $90. We're trading at 95. You put this thing longer term, man. You've just been shopping around at the COVID lows, pretty much, right? You see the consolidation area, basically the area that you have that's kind of a headwind right now. $120 has been the area of resistance, and we're right near the bottom line of that, though, man. $90, 95 is the floor for Disney. You got the ability to hold this one longer term, you know. Might not be the worst case to start pricing into this equity at $95, folks. Now, I've done this scenario a couple times, okay? To illustrate the areas on this chart real quickly, now a lot's changed. This is a 5-year weekly going back on Disney. I'll give you my take, all right? And I have to update some of these values on Disney here in terms of just their correlation, in terms of the shares, in terms of how it's trading into it, what's happened since then, right? You got the earnings event that happened last November. We got some big-time volume there that's not on this chart, so don't pay attention to all this stuff yet, okay? But fundamentally, understanding Disney and understanding this run-up it had in basically the entire part of 2019, that was Disney Plus starting, okay? The first acceleration in April was when Disney Plus first announced their plan. Okay, nobody knew. Were they going to go HBO? Were they going to go high-priced tier? Were they going to try and be a premium brand to even Netflix? No. What did they do? They undercut Netflix, and they came in at like $5 a month. Before they even go live, market says, that's phenomenal. We love that idea. We don't care about money right now, just as long as you get everybody in the world on Disney Plus. So the stock goes from 115 up to what? 142 by the end of that month. You continue climbing to 147. I think late in the year, and I have to check this one, and maybe if I'm wrong, tell me, but I'm pretty sure, this is when Disney Plus starts to go live. Disney Plus goes live, you trade up to 153. Well, what happens? We come into COVID, things drop out of bed in the middle of February. By the time you're at March 16th, these are weekly bars, you're trading at $79. Now, point being, okay, the movie theater business has changed, okay, completely. It's still going to be around, folks. Disney still produces juggernauts. They got some brands that you can't match in there, okay? I mentioned our man Kevin Hincks. We keep TV to a household minimum, but a little morning cartoons with some breakfast sometimes. We were up for a couple hours before that, playing with trains, playing with Thomas the Train, playing with dinosaurs. Finally, you have a little bit of breakfast. You think about where this equity was. The estimates that they were coming out, folks, in 2019 of where Disney Plus would be, absolutely blowing it away. Absolutely blowing it away. Okay, every single metric, except for the fact that it's costing them a little bit more money than they maybe thought. Yeah, and that was a big concern. That's why Chapman got out. That's why they got Iger back. and we'll see where it goes. But, you look at this thing, man. You're getting into prices that Disney was trading at 2015, folks. Okay, and it's been an exceptional 8 years for them in the Disney Plus arena. And if you have kids and you understand the amount of money that you spend and you understand where Disney is, you're going to make it to Disney, man. Disney, there's only one Disney, and we're very fortunate to live in Florida because we have so many perks that come with that in terms of Busch Gardens is amazing. That's just in the backyard. I've talked about the yearly plan for Busch Gardens is probably one of the best values that I get as a parent especially. It's like $250 for all year. Your kid gets in for free. We just go in there for a Saturday afternoon, walk around, see the giraffes, see everything. So we get all those perks here. But there's only one Disney, man. Busch Gardens ain't Disney, okay? And, yeah, so we'll see where it goes. But keep that in mind when you talk about some of those numbers because it blew away all estimation in terms of those numbers. And you can see that this has been basically a consolidation, right? Between 120 has been a headwind. It was a headwind in 2015. You got up to 116 in 2017. You got up to 120.20 in 2018. Disney Plus exuberance got a hold of everybody in 2019. 2020 had the pandemic. 2021 blew things out of the water. And what have we done? We're just right back in that consolidation. And we're almost at the bottom part of that consolidation at 95.32. Pretty interesting on Disney. Okay, we jump around to what else is going on this morning. Excuse me as I back off. So, yeah, we're going to talk a little bit more about BlackRock for a minute. But first, before we do, how about Signature Bank? So some put options holders say their brokers have made it difficult to exercise their options. The stock hasn't opened, right? Well, guess what? They're open today. Yeah, and this goes for Signature and Silicon Valley Bank. It's been almost 3 weeks, right? SBNY is Signature Bank, and there you go. You finally open. You go from a price point of, you got to go back to a daily here, where you're trading at March 10th, so 18 days ago. You close at, what, $70. Today you open at 30 pennies. So, yeah, and they're talking about no options yet, huh? So how does that work? I know, we're going to get a lesson here, and this is kind of what the article talks about here. Some traders say the brokers have made it hard to exercise the options. Others say they're stuck posting thousands of dollars in collateral, or the brokers just keep open the possibility that they'll be able to close out the trades. None of us anticipated this type of friction and uncertainty. That's one trader who had puts tried to Signature Bank. They've been on Twitter, so you have them spectacularly failing. What makes the situation unusual is that the threat of bankruptcy wasn't reflected in their stock prices at the time of their collapse. Pretty amazing, right? Shares, for example, yeah, you have other companies that were trading below $1 before they go BK, all right? These companies, how does this happen, man? This is where I just realized that you think you know more, man. You don't know more than the market, okay? So brokers appear to be valuing the shares at starkly different levels. Fidelity has marked the shares at 0. Schwab has put Signature at 64.60 and Silicon Valley Bank at 39.25. There's no historical playbook for the brokerages to refer. I don't know how it's going to play out, man, but 26 cents seems pretty good. Stay tuned, folks. We'll finish this conversation when we get back.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Are you looking for a way to consistently add winning trades to your portfolio? Tom O'Brien is here to help. Tom O'Brien has been successfully trading markets for over 30 years. A frequent contributor to TD Ameritrade Network and CNBC, Tom O'Brien founded TFNN over 20 years ago to help educate investors just like you. Tom's daily market newsletter, Market Insights, is published every morning when the markets open to give you the competitive informational edge you need to succeed. These newsletters are packed full of Tom's advanced technical analysis and are geared to deliver comprehensive strategies for a successful portfolio. Get Tom O'Brien's newsletter, Market Insights, today, and try all of our products and newsletters 30 days risk-free with our money-back guarantee at TFNN.com. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We got the S&P right now negative by about 9, pretty much where we kicked off the session right now. You see a little bit of volatility down to 39.95. We're trading right now at 39.98. Yeah, so getting back to the article we're talking about with Signature and Silicon Valley Bank. I mean, some of the people in here, it's really interesting, and there's basically no playbook for this. No historical playbook. The options mania that characterizes today's markets, not a fixture during the last round of bank failures, so social media is in there as well. And, I mean, what they talk about in here is the amount of capital some of these people are having to put up here to hold these positions when realistically that's a much more capital-intensive requirement than probably is necessary. You had one trader in here being told by the brokerage, now which one are they talking about here? Robinhood, okay? Robinhood values them at the close of Friday, I believe. Yeah, Robinhood values Silicon Valley Bank at $39.40, where it last traded March 10th. It put Signature Bank shares at $70, their last closing price. Well, I just pulled up Signature Bank. It's trading at 30 pennies. Not quite the same deal. You had one person had to put 20 grand into his Robinhood account because he had to get up to the risk threshold that he exceeded and to keep those short positions. You had other investors asking for parents to put their homes up. But pretty remarkable, man. You get a drop off from $70, from $40 to zero over the weekend. Yeah, and I don't know who was holding those stocks over the weekend, folks. And that's why you always want to be looking at risk reward, man. And risk reward, and that's what's so worrisome. Like bigger picture about what's going on right now, because risk reward wise in this market, what are you doing business with First Republic for? Especially if you got over $250,000 in your account, man. You are just playing with fire. And that's probably much more risk than any potential reward for banking with one individual bank that's teetering on the border of collapse, to put it lightly. Now, that's deposits. I understand why you're potentially buying this equity if you think it's going to survive, because you just went from $120 down to $10 or $14. But understand the risk like it was in Signature. You better believe that everything you're putting into this equity, if you're holding it overnight, might go to zero the next day. Yeah, because Signature Bank is at 21 pennies right now. And what was it? What's SIVB? Silicon Valley Bank. Yeah, they're not open. Oh, look, so I have it at 39.25, right? That's interesting. So that's going to be how they're pricing it right now. Put it back to a daily. Yeah. Yeah, not since March 9th. But somehow they got a bid ask of 39, which is where they're valuing Silicon Valley Bank right now. Okay, let's jump around to some of the articles I have pulled up here. Kevin Hincks talked about Facebook. It's been quite a chart, man. Meta plans lower bonus payouts for some staff. They're trimming the line, man. Seems like Zuckerberg woke up to, man, that stock really got punished in terms of a demise. We back it up to even a 5-year weekly to see the full collapse from 384 to 88. Now, what are we dealing with on Fibonacci here? Let's see what we're getting into. Look at that. Watch out, folks. Right at the 382, man. Going to be an important one when they talk about their earnings. I think they were coming up April 26th, I think, when I was looking at it. Yeah, April 26th, they'll be out. You got a lot of expectations, this equity, all the way back to February of last year, but that's still a 50% haircut from where it was at 384. But guess what? Keep in mind, man, 245, you're going to face some headwind, man. From 245 to even the 270 area, that's 618. That might be a nice projection if they crush it for earnings right now. But keep in mind, man, we're going to be dealing with some rate woes for the time being going forward, folks. I mean, look at the weekly, right? You charge out of here. The weekly, it's only Tuesday, is almost 2 full points wide on the 10-year already. Just mammoth moves, to put it lightly, and we're going to be approaching the lows that we were talking about at about 6 a.m. this morning, 114.18 about on the 10-year. Headline from Disney. They'll be talking about Disney on Fast Market. Not really important. They're talking about 50 employees here for a company. But they're the Metaverse. They have a Metaverse division. Did not know that even. The company plans layoffs. Looks like maybe they don't want to get on the Metaverse ride that Meta had been on. Eliminated its next generation storytelling and consumer experiences unit. The small division was developing Metaverse strategies, according to People. Yeah, so they're laying off 7,000. Those 50, all the teams 50 have lost their jobs. And let's see, headed by Mike White, former Disney consumer products executive, the division was tasked with finding ways to tell interactive stories in new technological formats using Disney's extensive library of intellectual property. People said, sounds like they're just too much cost, and the dividends that we'll pay from that type of work are going to be too far into the future for what's going on with Disney right now. And that's where, folks, what I'm talking about. All right, you got layoffs, you got Iger in there. They're going to turn things around, man. Okay, there's only one Disney, and they have quite the library. And, yeah, so getting it where it was, in 2015, folks. I mean, think about it. Longer term, your kids' retirement account, something like that. If you can scale in the middle of 2023 and you can start scaling in at 2015 prices, don't load it up because this market might have some trouble going forward, okay? The next year or two might be a little dicey if the Fed plots play out when the market doesn't believe them right now. Keep that in mind. But risk-reward, man, you can't go wrong, in my opinion. All right, what else we got? Alibaba, how about this one, right? Splitting into 6 groups and explore separate IPOs in a major shakeup. The tech giant from China makes announcement a day after the co-founder Jack Ma returned to mainland China. He's making the reappearance. I was talking about him just recently. Back in mainland China after almost a year overseas. I think they literally told him to get lost for a year, get out of China, don't make any headlines, don't do anything. And it seems like he did that. I wonder what the threat was on the other side if he did not do that. And there's your acceleration on that news. Alibaba, 86 to 97. You get back some of that. We put it up on a 3-year weekly. Quite a downtrend channel, right? From the middle of 2020, you trade down to lows basically March 14th of $73. And all you've been doing is shopping around in that area since then, folks. And I'd be careful, to put it lightly. I mean, yeah, that's a pop, but look at this chart longer term. All you're doing is bouncing off an area that's been support at about $80. You got down to 58 last year. It's possible. And again, you're searching for some high risk, high reward trades. Yeah, China might be there because the volatility you're getting, right? You just traded from 120 down to 80. You just lost 33% of your value in Alibaba over about the last 2 months. Well, guess what? You just gained almost 20% from where it was trading at last week. So you got some volatility, but be careful of China, man. Because I believe that the rhetoric's ratcheting up, and it's tough to go back. It's very tough to unwind things, and that's the worry when you start getting 2 nuclear giants going at it, right? And things just seem to get worse, and TikTok is not going to help, man. And, yeah, so Baba getting a shift today, but just realize the risks if you're putting any money at risk over in China. All right, what else we got pulled out here? We talked about the rates. Let's talk about Mr. Gundlach. He's talking about a U.S. recession will start in a few months. It's going to be such an interesting 3, 6, or 9 months down the line. 3, 6, and 9 months. All those time frames, folks. He said on CNBC, a U.S. recession will start in a few months. The Federal Reserve will need to respond very dramatically. How bad that recession going to be if they need to respond very dramatically? Headwinds are building. We've been talking about this for a while. I think a recession is here in a few months. All we really need is the unemployment rate to go higher. Well, if that's something we need. He anticipates the Fed will cut interest rates a couple times this year. The overall state of the economy is clearly weak. What happens to inflation in that case, right? Talk a little bit more about that. Is inflation no longer a threat if the economy is crashing? I don't know how that plays out. We'll see. S&Ps down by 5. Stay tuned. Be right back, folks.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We have the S&Ps down about 4 points right now. Just take a look on a Fibonacci basis, folks. From the highs that we had, let me get that right. Talking about this year, going back to the highs of basically February 2nd. You could take the high from February 14th or 16th. February 14th is the same area, okay? About 41.86. You hit 41.8650 on February 14th. You drive down to a price point of about 38.40, almost 2 weeks ago. We basically hit that 618. On March 22nd, you got up to a price point of 4,073. So it's going to be interesting. That was also the area that you sold off from on March 6th. In this market, you put this back and you take that Fibonacci number off of there. And just taking a look at this as a technical trader, folks, and I'm going to go back a little bit further to a 3-year weekly. I'm not so sure that's a bullish trend going on right now, man. And I do not understand where markets need to be in terms of where inflation goes. That's the thing that's missing when you go over it over and over. When you talk about people talking about Fed cuts, people talking about the strain on the economy that's coming, okay? But I haven't heard anybody make a reasonable case about where inflation goes in that regard, okay? I just haven't seen it. And the sticky parts of inflation in this economy, the core services, et cetera, I don't know if that's going to tame everything in terms of the banking, the crisis, the recession. And if it does, it's going to have to be pretty dramatic, man. It's going to have to be pretty dramatic, where even if we get those cuts, I don't know if the market's going to like it, because we're only getting the cuts because things are so dire, and the market's going to have to probably trade down substantially before we get those cuts. Market might like those cuts when we get them, but you're not going to get cuts when the market's trading at 4,000 and inflation is still present. So that's the fundamental take. The best part about it is we get to see it play out, folks. VIX, not that bad, man. With the volatility I expect, sitting at 2064. I think we still got some volatility coming down the line, folks. S&P's negative by 6. NASDAQ slightly in the red. You got Dow up 38 points. You got the Russell up by 3. Stay tuned, folks. We got our man Basil Chapman. He's coming up next with the Tiger Technicians Hour. And yeah, can't wait to talk to you tomorrow already. Thanks for starting your trading day with me, folks. Stay tuned for Basil. Live programming coming up after that. Have a great one, folks.